Welcome back to Morning Trade Live. Joining us to kick off the week, Jim Bianco is the president at Bianco Research. Always got an interesting take on the markets and macro. Jim, good morning. Hey, one of the things that kind of slid under the radar last week is that the economic surprise rate started beating again, or rather stopped missing expectations so severely, I should say. It's been turning up now for the first time in months. How important is that here as we kind of figure out how the market responds to the big 50 bip cut?
No, I think it is important. I think that the assumption that has been underlying all of this 50 basis point cut and future cuts is this idea that the U.S. economy is going to have a soft landing. And I've been on with you before, and I've criticized this whole idea of a soft landing because it doesn't really have a definition. So it's the Wall Street's perfect forecast. Forecast something that you can't define, and then you can define it in a year until you were right. But more to the point, if the economy is going to stay stronger than people think, and we are now going to inject it with steroids, otherwise known as cheap money, by the Fed cutting rates, I get worried as a no-lander, as somebody who thinks the economy was growing at potential anyway. We're going to overdo it, and we're going to wind up with another spurt of inflation, probably sometime in 25, probably the second half of 2025. And that's going to be a real problem for the bond market. And if it is a problem for the bond market, it's usually a problem for all asset markets.
It seems like we've kind of had this back and forth with the concept of reflation, particularly in 2023, because we came down so hard from the highs of inflation, and then we plateaued. Economic data did end up staying strong enough last year to prevent, a major downturn. So have we experimented with this kind of notion of the surprising stability? And so far, we managed to get inflation to roll back over. How come that wouldn't happen again, Jim? How come it's not just step down, like stepwise process lower?
I mean, it could be. I mean, let's remember now that most economists, if they're honest, will tell you that the single hardest thing to understand and to model is inflation. It is a very difficult thing. Ironically, most people will tell you it's the easiest thing. Oh, just look at money supply, or just look at this or that, and you can tell where inflation's going to go, or inflation expectations. And none of those things actually ever work very well in trying to predict inflation. So could it step down? Sure. But I've been operating under the assumption that the economic cycle turned in 2020, and that was the cyclical low in interest rates when we hit 50 basis points or 0.5% in the 10-year note. We're in a multi-year bear market in bonds. And that seems to be the case right now. We're in the fifth year of that bear market because they bottomed over 4 years ago right now. And with that, we've had much stronger growth. We've had much stickier inflation. Even though we're talking about inflation being defeated, every single inflation statistic today, right now, is higher than anything seen between 2010 and 2020. So we're still step function higher than anything we saw in the previous decade when it comes to inflation. Now, can you get inflation down more? Sure. If you have severe economic weakness, like a recession, it could come down. But can you get inflation down more and maintain growth at the same time? That's really what I'm really questioning. And why do I think that we're going to have inflation? We've got deglobalization. We've got a massive change in the workforce with remote work. We've got big, huge budget deficits and huge government spending. All of those things add up to the idea that we might be in a 3 to 4% inflation world, talking about core inflation or so. And that's exactly where core inflation is right now.
Jim, a lot of folks argue that housing is the slowest moving piece of the inflation data that the Fed watches, and then that's kind of set to break lower. But I guess if they do support housing by dropping 50 bips, there's maybe one area that a lot of folks expect to soften up that might just do the opposite.
Yeah, no, I think it will do the opposite. A lot of the data, this gets into another issue that everybody kind of talks about at the periphery, and Jay Powell mentioned it last week. The population growth of this country is at a 30-year high right now. It has exploded higher from 0.2% population growth 4 years ago to 1.2% right now. What's driving the population growth is migration. Millions of people are coming over the border every year. And what that does is two things. It's increasing the unemployment rate, and this is exactly what Jay Powell said last week. The unemployment rate is going up, not because anybody's losing their job, because every day more unemployed people come into the country. The second thing it's doing is it requires millions of housing units for these people, and it's creating a housing shortage. That's why every housing statistic is weak. Sales, starts, permits, the outlook, except prices. They're at an all-time high and they keep going up. We've got a shortage of units because we need millions more because we've got 7 to 15 million more people in the country than we did 4 years ago. So if you're going to drop rates and you're going to add more demand to housing, you're just going to produce even higher prices in this environment. I think this is the thing that most people forget, or most people don't want to acknowledge because it's politically touchy, is the migration is causing a big population change in this country, and that is skewing a lot of economic data right now.
Jim, what then do we have to try and calculate if this is a major role? I don't want to go too off because I want to come back to some charts you got, but just to that point, I mean, with November, the election, do we need to be thinking about immigration calculus as an economic input now?
I do think we need to. I mean, if you want to go, if you want to go for the employment report, like I said, all of the payroll reports and all of the unemployment reports from the household survey, they're all surveys, and the surveys are adjusted by population. And when the population is growing quickly and they look at the cohorts of where it's growing, is they do a survey, they adjust it by population, we have more unemployed people. Everybody assumes that means people lost their jobs. And actually, the surveys are showing no one's really losing their job right now. The layoff numbers are very low. The initial claims numbers are very low. So we need to kind of start thinking about what that means. And again, like I said, with housing, it's also driving housing prices higher, but we don't want to touch that issue. So maybe we need to, at least from an economic standpoint, I've made no judgment about whether or not there should or shouldn't be, but the reality is the population growth is the biggest driver of the economic data right now.
All right, let's talk some of the economic data drivers, Jim. One group of data points that seemingly have major sway, or at least used to, are the leading economic indicators as kind of a good assessments. But so far, according to your analysis, their path has not been as predictable as normal in terms of kind of their impact. You got some pretty interesting charts. That was a subject of a report on the LEIs. Take me through it, because right now, I mean, just on the surface, they've gone through a very, very extended period of weakness.
Yeah, so the LEI, the Index of Leading Economic Indicators, is put out by the Conference Board. It's a model. It's a model of 10 economic indicators. 3 of them are financials, S&P, yield curve, and credit. And the others are economic, that are supposed to predict the economy. What I've argued about this is, if you ask most economists, how does the economy work and what are the things that predict the economy, they'll tell you it's these 10 indicators in some version of what the LEI is. It has fallen now for 30 consecutive months. It is at the lowest level it's been in 7 years. And there's the chart of it right there. If you look at this index versus its history, we should be in the middle of a very bad recession. The stock market should be down 50% right now. The unemployment rate should be between 8 and 10%. It should be as bad as it was in 2009 right now. We've got nothing of the sort. So what I've argued is this indicator is not working. And I used the famous George Box, he's a UK statistician, statement, all models are wrong, and this is a model and it's wrong, but some are useful. And this is useful because it tells you that the standard analysis of this economy isn't working in the post-pandemic economy. This economy changed in 2020. Change is not worse. Change is not dystopian. It's different. And we keep applying 2019 or pre-COVID rules to how the economy should work. And we then keep saying either inflation's dead or the economy's in trouble. The Fed's got to cut rates hundreds of basis points. But it isn't working that way anymore. And we have yet to really understand how it's working. I'm not going to tell you I know how it's going to work. I just know that the rules that we're using aren't working right now. And that's what the LEI is kind of signaling to me.
And we were just looking at how long that's been negative, but GDP is still positive and generally surprising positive. We did just get a fresh revision last week up to 3% from the Atlanta Fed GDP. So if historic models are going to break, and this time maybe is different, Jim, should I let go of my yield curve truther in me then? Because the one that Cam Harvey did study for that entire thesis is the 3-month curve, which did just finally start to uninvert last week with the Fed cutting, and that's when his story tells us recession's getting closer. So do we ditch the yield curve stuff? Do we ditch the SOM rule?
Well, the SOM rule's been messed up because of the population growth causing the unemployment rate rise.
The immigration stuff.
As far as the yield curve, I think that the argument I've made with the yield curve and the others have made is it's actually the uninversion of the curve, and that would be the 3-month 10-year, which is still about a minus 100 basis points.
Yeah.
It's the uninversion of the curve that's always been the signal of trouble. But in the past, the yield curve would only invert for 40 or 50 days. So if you pick the yield curve inversion date or the uninversion date, you kind of came to the same answer. This time we're approaching 700 days now that the yield curve has been inverted. So I'd still argue that it might still work. Let's see what happens when the yield curve eventually uninverts to see which way it goes from there. So all hope is not lost when it comes to the yield curve.
Okay. We're looking through some of the things that you put in your notes too that I like, which is some indicators seem to say perfect. We're not in recession. Others seem to say we definitely are. To your point, it seems like right now we kind of have to give the benefit of the doubt to the economy, which has continued to surprise at every turn. So should we start shorting bonds again then, Jim?
Yeah. So basically, just real quick on that, the SOM indicator is perfect that we are in a recession, but the stock market made a new all-time high last month.
Right.
In the last 80 years, the number of months that it's made a new all-time high in a recession is 0.
Wow.
So you've got two perfect indicators telling you exactly the opposite. As far as the bond market goes, if the Fed is right that they're going to go to 3.25 on the 10-year, on the funds rate, that seems to be where all these roads are leading. It's down to about 3.25. Where does the 2-year note trade when the curve renormalizes? About 360. It's about 360 right now. Where's the 10-year note trade if the 2-year note's at around 360 in a normal curve environment? About 100 basis points above the 2-year note, which is around 460. The 10-year note's at 375. So if everything normalizes, the 10-year note should go up 80 or 90 basis points from here. What would keep it down is if we had a bad recession. How do I know we have a bad recession? Stock market's down 20, 30, or 40%. That would be your signal that we were having a bad recession. But it is making a new all-time high. And when it makes a new all-time high, there's a 0 chance, or at least a 0 instance that we're in recession according to history. So if everything is okay, then the next move in the 10-year note should be that it would go up. Now, we're in a post-crisis period and all this other stuff, but that yield curve relationship has worked pre-crisis from 2008, post-crisis. It seems to always work. So that one seems to be immune to any kind of cycle change. So if we're going to normalize the curve, and everybody keeps talking about the curve's re-steepening, that's actually a bearish 10-year call, because the curve is going to re-steepen by the 10-year going back to 4.5. It's not going to steepen because the funds rate's going to 1% and the 2-year note's going to go to 150. That would only happen if we had a bad recession. And again, then we'll have a bad stock market if we're going to have a bad recession and the stock market's going the other way.
All right. So it seems like you think we could continue to see some of the bears steepening with the 10-year moving higher. Also like that stat about stock market highs and recession. Really good stuff. Good perspective. Thanks, Jim.
Thank you.
Yeah, I like it. Jim Bianco, president of Bianco Research. We're at the bells. We're at the start of the